Good morning and Jai Hind. After studying the liquidity ratio and solvency ratio, the third category of accounting ratio is ratio, or we may say turnover ratio. These kinds of ratios usually measures the efficiency and rapidity of the resources of the company. That means it indicates how rapidly the resources has been utilized for creation of the revenue from operation. So the first ratio under this category is inventory turnover ratio. This ratio indicates the relationship between the cost of revenue from operation during the year and average inventory. So formula is given here, you can see, and it is represented in times. So we can calculate the cost of revenue from operation by two ways. The first formula is given here, that we can add opening inventory, purchases, carriage wages, other direct charges, and out of that we have to subtract closing inventory. This is the first way to calculate, or first formula to calculate, cost of revenue from operation. While we can calculate this by subtracting gross profit or adding gross loss in revenue from operation. In both ways, we can easily calculate the cost of revenue from operation. And the next thing which is required to calculate is average inventory. So for that, you can add opening inventory and closing inventory, and the result should be divided by 2. In this way, we can calculate the required items for the calculation of inventory turnover ratio. So as I have told you that this kind of ratio is represented in times form. Just we have studied in case of interest coverage ratio, here also the ratio is represented in times form, and if the ratio is more, that means it is that means the resources of the company is utilized very rapidly in the generation of revenue, then it is good for the company. It is a secure financial condition of the company. And if the ratio is low, then obviously it is not a good sign for the company. Let us see average age of inventory. It is also known as inventory holding period. Average age of inventory can be calculated by dividing days in a year up by inventory turnover ratio. The second type of activity ratio or turnover ratio is trade receivable turnover ratio. This ratio indicates a relationship between credit revenue from operation, that means credit sales, and the average trade receivables. We can calculate average trade receivables by adding the opening trade receivables and closing trade receivables and dividing the result by 2. In this, we don't consider the bad or doubtful debts. That means we don't use to deduct the value or decrease or subtract the value of bad and doubtful debts from the total debts, because we don't want to increase the or give the false value of trade receivable turnover ratio. If we do so, then the value of this ratio increases, and which gives false impression about the uh, relationship between the credit sales and trade receivables. So this ratio represents the speed with which the amount is collected from trade receivables. And if the ratio comes to be in big number, that means this is good condition for the company. This is good, in fact, if the value of this ratio is big or have or more, because it shows that very frequently the creditors are paying their debts, and this obviously shows a good credit policy, good credit sales policy of the firm, and vice versa also. If the ratio comes to be low, then in that case it can be assumed that a company is following an inefficient sale credit policy. That means few decisions to be taken regarding that. So with this, I'm going to end my video. Thank you.